Joining me now is Labenthal Global Advisors President and Chief Investment Officer Dominick Tavella. Hey, good morning, Dominick.
Good morning. How are you?
Good. How you feeling?
Feeling great. Back in the studio.
Yeah, well, you are back in the studio. We're all here with you. Talk to me about retail. It's been an interesting little a couple of reports we've had, in particular from Macy's.
Yeah, it's kind of been a mixed story, and we have about 70–80% of the companies reporting beating on the earnings side, but a lot of them are missing on the top, right? Yep. They're missing on the sales, and that's the consumer feeling a lot of pressure, and they're refocusing where they're spending money. The bad news here is that overall earnings have been lowered by analysts, right? Where we started in January compared to today is much lower expectations. They're beating, but a lot of retailers are struggling.
And you talk about consumer pressure, watching bond yields. Okay, so you see the 10-year at 4.3, you see the 2-year going above 5. But I think about it from a mortgage and auto loan perspective. As a consumer, I'm sitting here saying, okay, so if I want to buy a house, I'm paying 7% or more. If I want to buy a car, which are record level prices, I'm paying 9.5%. So you look at these retailers and you say, people are just getting hit from every corner.
And look at the credit card rates now that you're paying interest on those credit cards. Look what you're paying on car loans today. And this is where the consumer's feeling the pressure, right? And we're watching the savings that they had accumulated during COVID. They had extraordinary amount of savings. That's really draining down and likely to run out over the next 3 to 6 months.
Personal savings rates are going down to your point. Credit card spending is going higher. Amber already told us this morning, not happy with Macy's website. We've had a lot of news covered already.
Or my mortgage rate.
Brian can't get a house. I mean, this, another one anyway.
One last point on that, and Dick's brought it up in their reporting, thefts have become a real integral part of their reporting now. We're going, wait a minute, now are we struggling putting the stuff out there and selling it, but thefts are really taken away from the bottom line. So this is an issue.
I know where Target came out last quarter and they were like, they were calling it shrinkage. We're like, you mean retail theft, as in people running out the front door of Target and Walmart with everything in their arms.
I mean, do you think these companies are going to start changing the tone of this? I mean, it has been shrinkage. Like, we have shrinkage problems. No, you don't. You have theft problems. You have crime problems. You're one of the primary movers in your community. Could you please go to your mayor and governor and speak in plain terms about the problem? Do you see that changing?
Well, we're certainly seeing retailers speak up about it, right? We got to deal with this political correctness, but they're speaking up about it. But what are they going to do at that point if they're not getting local support in solving the problem? It's not going to go away. It doesn't look like it's going to go away anytime soon.
We haven't gotten to this yet this morning, but S&P Global cut the credit ratings for the banks, revising their outlook for several U.S. banks this morning. They're talking about funding risks. I want to ask you about that and weaker profitability. And they say that basically they downgraded the ratings of Associated Bank, Corp, Valley National, UMB Financial, Comerica Bank. None of this is good. Key Corp. Dominick, Kevin O'Leary's been on the show already and said he thinks there's a lot more bank failures to come.
I wouldn't go that far in terms of a lot, but a few more, sure. And this follows in what Moody did and Fitch did. So it's just a realization of the facts. Banks, in order to keep the deposits, have to pay a higher rate to those depositors. They have to compete. Otherwise, people are just going to move their money out, right? So they're spending more money to keep the deposits on hand, and they have greater credit risk on the other side, whether it's commercial loans, whether it's retail loans, whether it's consumer loans. So they're kind of caught in this rock and a hard place where they got to pay more money to keep the deposits there. They may be losing more money, especially in the industrial, office space, real estate sectors. So they're squeezing the profit margins.
Yeah. No, and I mean, also, too, you mentioned commercial real estate briefly there. That's really the problem with these banks. A lot of these notes are going to come due this year and next year. I mean, and look, I go back to Kevin O'Leary. He's pretty bearish. He's like, I think half these banks are going to be gone, which is a little frightening, obviously.
Again, I think that's a little bit extreme. The good news on that side is that all these loans don't come due in one day, right? If you look at commercial loans, they're rolling. This institution's going to renew that one. And a lot of these institutions will have time to solve their problems. there are going to be some significant problems.
Well, the other side of that is maybe you don't get the failure best case scenario, but you do get tightening credit.
Absolutely.
Which is a huge depressant for the economy.
Absolutely, and lower profits. And I'll throw one last one in there. Their ability and willingness to make new loans is way down.
Right.
Way down.
Right.
Yeah, look, Brian's over here struggling. We hear it.
I think we might be overplaying my struggles on the housing front just a little bit, but to all those mortgage aspirant people, it is tough out there right now.
I know. No, you're right. 7% or more is not a fun number to stare down when you're trying to buy a house. Dominick, it's good to see you.
My pleasure.
All right.